Hello everybody and welcome to the Week in Markets. I'm Faye Graham, an investment analyst on the True Potential portfolios, and I'm delighted to be joined today by Paul Durrans, one of our investment directors. So Paul, really all eyes have been on the US this afternoon with PCE, the Fed's preferred inflation measure, out. Inflation in the US has been on a downward but bumpy trajectory. Expectations were for headline and core to come in both slightly lower. I suppose, what did the report show?
Yeah, well, it was a pleasing report because inflation came in at, as expected, at 2.6%. So that's for headline inflation and core inflation. So core inflation really removes the volatile components of energy and food. And it's actually the measure that the Federal Reserve really focus on. So that came in at 2.6%. And if you think, if we go back to June 2022, inflation, headline PCE inflation was at 7.1%. So we've come a long way, which is encouraging, and the Federal Reserve wants to get to 2%. So we're not far off. I suppose when we look at the inflation basket, we look at goods and we look at services. Goods is actually reading negative prices, so it was down minus 0.4% month on month, and that's really pulling inflation down. But you have stickier services inflation, but encouraging that that's actually moderating. So last month it was up 0.3% month on month. This month it's up 0.2%, so it's gradually falling, and that's what the Federal Reserve really wants to see. So on the whole, a good inflation report, and that's what we've seen in markets. We've seen bonds rally a little bit, and when we looked at equity futures in the US, they were also up a little bit. So all in all, pretty good.
Yeah, so encouraging signs of cooling now with inflation.
Yeah.
I suppose any implications for interest rates from that?
Yeah, initially no, but I think with inflation at its lowest reading over the last 3 years, and if we look at core inflation, that's actually below the Federal Reserve's end of year forecast. So they're forecasting 2.8%. It's coming in at 2.6%. I think if you get any further normalization in the labour markets, i.e. slower hiring rates or a turn up in unemployment figures, then I do expect the Federal Reserve to start cutting interest rates in the coming months.
Yeah, I suppose moving on to Europe, we also had inflation reports from France, Italy and Spain this morning as well. Yep. So a good indicator of Eurozone inflation, which is out actually early next week. I suppose a key area of focus that the markets have been really quite focused on within the inflation report is services inflation, which has been proving quite sticky within Europe. We had the ECB cut interest rates in the last meeting, but for them to really continue cutting, we need to see inflation pressures ease within the services sector as well. So I suppose what did we see within the inflation reports this morning?
Yeah, it's a challenge for the ECB because you've got different economies performing differently. They've got different inflation rates. When we look at France, they came in at 2.5%. Their inflation rate's on a downward trajectory. If you look at Spain, they came in at 3.4%. They're on an upward trajectory. So very difficult for the European Central Bank. I suppose they are really focusing on core inflation, which is more sticky. It's more sensitive to services inflation, which has been somewhat challenging, like it has been in the US and the UK. If we look at core inflation, that came in at the start of this month at 2.9% from 2.7%. So the trend is not favourable and is therefore likely keeping the European Central Bank very much patient and cautious to further interest rate cuts. But it is encouraging that they're actually lowering interest rates, and that should boost economic activity looking ahead.
Yeah, absolutely. And I suppose bringing that back home to the UK, last week we saw inflation actually come back to target, so back to 2%, the Bank of England's target. But again, a similar theme to Europe, where you've seen core inflation still be quite sticky, just given that services component. I suppose as well, we're on the last day of the quarter today, so good quarter for markets. You've got global equities set for another third straight quarter of positive returns, really spurred on by the ongoing strength of the US economy, as well as that broadening growth theme and inflation coming down within developed market regions, which is allowing several central banks to actually start cutting interest rates. What have really been the key drivers of markets and the key standout performers for you?
Yeah, it's been a great quarter for investors. You know, it's never easy. There's always a lot of uncertainty, always something to worry about, whether that's high valuations, geopolitics, elections around the world. And so there's always something to worry about, but you have been rewarded for being invested. And, you know, those clients that have been willing to take more risk have generated probably more returns because they've been more exposed to equity markets. And the real standout over the quarter, once again, has been the US equity markets, up 5% as of the close of play yesterday. And it is a complex interplay between strong corporate earnings, which we did see in the first quarter, strong economic growth, which we're seeing in the US, and that's certainly where the strongest impulse is. But we've seen a bit of breadth or stronger recovery in the likes of the UK, Europe. UK this morning, we had a revision to the GDP, the first quarter GDP number revising upwards, which is good. Inflation's coming down, as we've just talked about, and interest rates in some central banks around the world are lowering, the likes of Europe, which is all encouraging. Where the US really stands out is its exposure to technology stocks, and these are the biggest companies in the world, but they're really harnessing and benefiting from the development within AI. There's huge enthusiasm within the markets over AI, and the US market has the exposure to the likes of Google, Amazon, Meta, Nvidia. I know I was just reflecting on Nvidia the other day. You know, Q1 delivered 82%. Q2 around 40%. You know, these are the largest companies in the US market, and that's really propelling equity returns for the US. But you've had good returns outside of the US as well. The UK's delivered just over 4%, emerging markets just over 4%, Japan closer to 3%. So really, global investors invested not only in the US have benefited, but when we look outside of equity markets, we've seen positive returns in global high yield. Gold is up 5%, and we've had, I suppose, flattish returns from sovereign bonds, but on the whole, pretty good returns for global multi-asset investors, which is certainly pleasing to see.
Absolutely. So really strong quarter for multi-asset investors, really propelled by earnings, that AI theme, cooling inflation, and really broadening growth as well. Strong returns from equities, and also good returns from fixed income. So thanks very much, Paul, and thanks everyone for joining us as well. We'll see you on Monday, where we'll put out another video then as well. Thanks very much.